Today, the weakest growth outlook in decades. Hello again, it's Martin North from Digital Finance Analytics. Welcome to Les Posts covering finance and property news. Today, I want to look at what the IMF has just said, because they have down forecast future growth over the next 5 years. And this does mark a very significant change in the trajectory of the economies around the world, with significant consequences down the track. So they said that poor monetary and fiscal policy, geopolitical uncertainty and isolationism, and also poor productivity are driving global growth lower. The IMF has warned that its outlook for global growth, economically speaking, over the next 5 years is the weakest in more than 3 decades, and they've urged nations to avoid economic fragmentation caused by geopolitical tensions and to take steps to bolster productivity. They see the world economy expanding by about 3% over the next half-decade as higher interest rates bite, according to Managing Director Kristalina Georgievina, who said this in a speech in Washington on Thursday. That's the lowest medium-term growth forecast since the 1990s and less than the 5-year average of 3.8% from the past 2 decades. For 2023, global gross domestic product will likely expand by less than 3%, she said. That's in line with the fund's forecast of 2.9% earlier on. About 90% of advanced economies will see growth slow this year as tighter monetary policy weighs on demand and slows economic activity in the US and the euro area. The IMF, by the way, plans to release a more detailed World Economic Outlook report on April the 11th as part of its spring meetings held together with the World Bank. Russia's invasion of Ukraine has worsened already tense relationships between the US and China, exacerbated the global inflation crisis, and is spurring hunger around the world. The world economy as a whole is now less able to support the weakest members, she said. Why? Because the peace dividend is gone. While some emerging markets are showing strength, particularly in Asia, with India and China expected to account for about half of global expansion, low-income nations are hamstrung by weakening demand for their exports, with their per capita income growth remaining below that of the emerging economies. Poverty and hunger that increased during the coronavirus pandemic could climb further. Despite the bleak growth outlook, high inflation means that central banks, they said, must continue to raise interest rates for as long as financial stability pressures remain limited after recent banking industry upheavals in the US and Switzerland. If the banking system does become unstable, policymakers will face more complicated trade-offs between inflation and the safeguarding of the financial system, she said. Be vigilant and more agile than ever. With rising geopolitical tensions, with inflation still running high, a robust recovery remains elusive, she said. That harms the prospects for everyone, especially for the most vulnerable people and the most vulnerable countries. The message comes on the day after the IMF warned that geopolitical fragmentation, driven by tensions between the US and China, risks damaging the global economy, with foreign direct investment and other capital increasingly being channeled towards aligned blocks of countries. She repeated a warning from January that longer-term trade fragmentation, including restrictions on migration, capital flows, and in international cooperation, could cut global gross domestic product by as much as 7%, equivalent to the combined annual output of Germany and Japan, or about $7 trillion. Interruptions to technology trade could see losses as large as 12% of GDP for some countries, she said. Getting on a path of less fragmentation in the world economy is good for everyone, she said in a television interview. Russia's invasion last year sent already strong inflation in many nations spiralling to the highest levels in decades, and Chinese President Xi Jinping's support for the Russian leader Vladimir Putin, including a high-profile trip to Moscow last month, drew criticism from the Biden administration and worsened the relationship between the US and China. Relations between the world's two largest economies have worsened in recent years, They deteriorated under former President Donald Trump, who kicked off a trade war that resulted in hundreds of billions of dollars in tit-for-tat tariffs. President Joe Biden's administration has sustained a hard line focused mainly on economic and national security concerns. Washington last year unleashed strict export controls on semiconductor technologies to China and has spent years targeting Huawei technologies. A leader in telecommunications infrastructure that the US has deemed a national security threat with ties to the Chinese government. Last week, Beijing opened a new front line in the escalating chip battle, launching a cybersecurity review of imports from America's largest memory chip maker, Micron Technology. And on Wednesday, US House Speaker Kevin McCarthy and a bipartisan group of lawmakers met with Taiwan's President Xi Jinping in California, a visit to the US that China has protested. Amid that conflict and after the supply chain disruptions of COVID-19, the US has encouraged nearshoring and friendshoring, urging companies to move suppliers into aligned countries closer to home, and particularly away from Asia and China. Georgina urged countries to be pragmatic about strengthening supply chains, and she also repeated a call for IMF members to provide debt relief to distressed nations and to contribute to a trust for the poorest countries that is short billions of dollars. And by the way, in a separate report, the IMF also said there are considerable risks to the financial system due to the rise of shadow banking, entities outside the normal financial regulatory environment, which have taken up more risky activities, which banks now shun. And the agency called for more transparent regulation to ensure financial stability ahead. So I think what we can say from here is that we are at a very significant point in the evolution of the financial system and indeed the economic system across the globe. And whilst the IMF, of course, is all for globalism and global cooperation, the real situation is that growth is definitely going to get strangled. Now, is that a good thing? Maybe, maybe not. Of course, the question always has been, can we continue to grow a planet which is full of just finite resources? Growth ultimately has to be able to be tamed if we are to survive. So it does beg a very interesting question. And whether the quest for growth, which is what they're really on about, is really a good quest, really does, to my mind, ask a critical question. And the bottom line, to my mind, is this, that growth at any cost is actually problematic. We need to find a more sustainable route to the future. But of course, that would require a whole new set of policies and philosophies, which at the moment seem, well, a long way away, when monetary policy still is pulling interest rate levers to try and tame inflation, and when growth, as measured by GDP, is all. Perhaps the truth is that we need a very different approach to setting an economic framework into the future, where growth, for its own sake, is not the only lever that's pulled. And that may have a significant impact in terms of corporate strategies, government policy, and indeed monetary policy. So why aren't we getting more articulation from some of these global bodies about some of these broader, more critical issues? It seems to me that they're all locked into this old mode of thinking. They are, frankly, neoliberals. And as I've said on past shows, the problem with the neoliberal philosophy is that the winners are the rich. Everybody else loses out. So I think it's time for a very different approach. But unfortunately, it's an approach that those neoliberals, the Davos mob, really are nowhere close to. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.